Hello, everybody. Welcome to my solution walkthrough for exercise 16-2 from Intermediate Accounting 17th edition CUSO textbook. I always call it CUSO, but it's actually the authors are Don CUSO, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, let's go ahead and get this going. I could have said get the accounting party started, but it's accounting after dark. All right, so we have here a bond conversion. So Aubrey, which is the name of the daughter from the Vacation films, very important fact, issued $4 million of 10% 10-year convertible bonds on June 1st, 2020 at 98 plus accrued interest. The bonds were dated April 1st. We're not fooling today. With interest payable on April 1st and October 1st. Bond discount is amortized semi-annually or twice per year on a straight line basis. Well, that's good. We don't have to use the effective. On April 1st, 2021, 1.5 million of these bonds were converted into 30,000 shares of $20 par value common stock. Accrued interest was paid in cash, non-sequential bills, no die packs. Very important for this accounting after dark at the time of the conversion. So the first thing we're going to do is prepare the entry to record the interest expense, but I don't even want to do that. I want to do the initial entry for these bonds because it's going to be a good review from chapter 14. Okay, so what did we do on June 1st, 2020? So on June 1st, 2020, I issued at 98 plus accrued interest, okay, these bonds. So that means that the bonds had a face value of 4 million. Okay, and I issued these at 98. So that basically essentially means that the amount of cash that I got from the bonds conversions themselves is 3,920,000. However, at the same time, they also gave me, they basically paid accrued interest. So the amount of interest on this bond, whenever we see an interest rate, it is always an annual rate. So I'm going to take over here. This is going to be the bond payable face amount. Is 4 million, right? My interest rate is 0.1. So my annual interest is going to be 400,000. However, this bond is paying interest semi-annually. So right over here, what I'm going to do is I'm going to take semi-annual. I'm going to multiply that by 6/12, and then I'm going to get my semi-annual interest. Woo, this is exciting. Okay. So right over here now, are they going to pay me that full $200,000? No, they're going to pay me, let's count them out. So the actual amount of basically the prepaid interest. So we issued over here plus accrued interest. So what we're going to have over here is April 1, 2020 or April 2020, May 2020. Because remember, this bond was issued on June 1st. So on October 1st, when I'm making that interest payment, I'm going to be giving them 200 grand. So because they're buying the bond within interest dates, what I have to go through to make this problem more interesting, it's enough dad humor for today, I'm going to go ahead and multiply this by 2.6. So when I get here, my interest payable or my cash up front for interest is going to be 200,000 times 2.6, and we're going to get that nice satanic number. Well, almost satanic. We've got 4 6s instead of 3. Okay, so right over here, we got June 1st, right? So what are we doing on June 1st? We know we're going to be getting cash, and that's going to be for the accrued interest right over here. And we're also going to be getting cash from the bond payable. The cash from the accrued interest is going to be 66,667. The cash I'm getting from the bond is 3,920,000. We always know that when we record our bond payable, we always do it at the face amount, right? However, Do I want to leave this for this cash for accrued interest? I'm going to have over here interest payable. So my interest payable is going to be 66,667. And then over here, the difference between these two amounts is going to be my discount on bonds payable. So right over here, my discount on bonds payable is going to be 80 grand. Okay, let's just add up the numbers to make sure that we're good to go. And oh my God, this is so exciting. We are in fact good to go. Perfect. Okay, to record issuance, bond issuance. Okay. Now, when it comes to, it's asking us to do the interest expense. I didn't have to do this, but this is going to give us a very important setup. So what happens when we get to October 1st, 2020? So right over here is that on October 1st, 2020, what's going to happen? Well, I know that on October 1st, 2020, I'm going to be paying out cash. And how much cash am I going to be paying out? It's going to be 200 grand. I also know that this is going to be settling my interest payable, right? Because once I pay this interest, this is why I got the cash upfront payment. I'm now basically paying out this interest, and there we go. So my amount of interest expense, okay, we almost want to kind of come here and say, oh, well, the interest expense is going to be the difference. But what we're forgetting about when it comes to interest expense, when we have a discount situation, is the journal entry that I typically will do is I will debit interest expense, and I'm going to credit that discount on bonds payable. Remember, when we're doing, if we're doing straight line amortization of the premium or discount, we figure out that discount first, and then that's going to determine whatever I need to do to balance is going to determine my amount of interest expense. Now, here's another thing that's very interesting about this question. Because the bond was issued 2 months into the bond term, out of this 10-year bond, right? And we've got 12 months per year. So we have over here 120, okay? So this is 120 months. However, the bond, this base, because this was issued 2 months in, right? What we're not going to be doing is we're not going to use the full 120 because the bond term is going to be minus the 2 months or April and May. So my months to amortize is going to be 118. So my monthly bond amortization is going to be right over here. It's going to be my discount amount. My discount is at 80,000. And then I'm going to divide this by months to amortize. So my months to amortize is 118. So my monthly bond amortization is going to be 678. I love these nice round numbers. Perfect. Okay. So right over here, when it comes to, well, how many months do I amortize the discount on October 1st, 2020? Well, because the bond was really only outstanding for, remember, April and May, they were not outstanding for. So we've got May, June, July, hold on, April, May, we've got June, July, August, September, because we're paying this on October 1st. This is going to be 4 months at 677.97. So this is going to be, if you're in my class, you can of course round up, and this is going to be times 4. So the amount of my interest expense is going to be whatever I need to do to balance this equation. So right over here, so my interest expense is going to be 136,045. Okay. So as we come over here, I'm just going to pause this real quick. So let's kind of see where we are. So when we have the bond payable, my face amount over here is at 4 million. My initial amount of my discount was over here at 80,000, right? And then over here on October 1st, I actually did it on the wrong side. That would be for a premium, but my discount over here is 80. And then over here on 10/1/20, the amount of I'm amortizing my discount by is going to be $2,711.86. So what I'm going to do now is, before I even get down to this conversion part, is that I'm converting on April 1st, 1.5 million of the bonds. And I'm converting those into 30,000 shares of $20 par value common stock. So what I'm going to do here is, on prepare the entries, what I want to do first is that I want to go ahead and record interest. Remember, when we have a conversion or if we're retiring bonds, we want to record the interest up until the date of the conversion. Here it's doing it on April 1st, so it's making it relatively easy for us. So we're going to go ahead and here for 1/21. Well, what happens when I pay bond interest on 4/1/21? Well, I always know that I'm going to have cash going out the door of 200,000, right? That's always going to be the same number. My interest expense, we don't know that number, but we do know what our discount on bonds payable is going to be, because this is going to be $677.97. We're paying it semi-annually, or it's going to be 6 months. Okay, so that means my interest expense over here is going to be $204,067.80. Come over here to my $4,004,067.80. So right over here. So before I did any sort of bond conversion on, this was on 4/1/21, the amount of my discount on bonds payable was $73,220. So again, if I'm doing a conversion of a bond, if I'm retiring a bond, I always want to record interest up until the date of the conversion. So recorded interest, assume the entry to record bond discount interest payment has been made. So now I'm converting what percentage of my bonds? Well, if I'm converting 1.5 million and my total face value of my bonds are 4 million, the percentage that this represents is roughly about 37.5%. So when I'm going to go through and I'm converting these bonds, what I have to do is I have to take off my books the cost or the amount of the discount that it relates to these bonds. So what I'm going to do over here, because my bonds are being converted, I'm going to go ahead and debit bonds payable over here on 4/1/21 for that amount of the conversion. Over here, I'm going to be crediting my discount on bonds payable by 37.5% or $27,040.58. Okay. So to take this off, basically record the conversion. So on 4/1/21, I'm debiting bonds payable for 1.5 million. And I'm going to be crediting discount on bonds payable for $27,458. We'll make this a nice, consistent coloring book for us. And now, when it comes over here to going through and recording the conversion, so I'm issuing 30,000 shares of $20 par value common stock. So what I'm going to do over here is I'm going to say common stock at par. And if you've seen any of my lectures from before, if you have a common stock that has a $20 par value, you need to have your head checked, because that is just not the right way to go. So look at my other videos and you can hear me rant and rave about that. Still love this book. It's just something that hopefully the authors are going to fix for the 19th edition. At least that's what they told me. Okay, so we've got bond payable, crediting discount on bond payable to take that off my books. Now I've got a problem, right? My journal entries have to balance out. So right over here, to balance my journal entry, I need a credit over here for 872 for the 872,542. And this is going to be additional paid in capital common stock. So this is how I'm going to be going through and recording that conversion of the bond. Okay. All right. So that kind of takes care of that question. Again, when you have something like this, what was the trickier part of this? The discount on bonds payable was an inter-interest period, conversion. And then you've got to kind of, but again, when it comes to bonds, I generally recommend to my students is that the general journal entry for a bond issuance never changes. I'm always going to be debiting cash, debiting discount, crediting bonds payable. Even if I have like the journal entry record interest expense, it's always going to look like this, right? Because I have to amortize that discount down to zero by the time the bond matures. So that does it for this particular question. So I want to thank Wiley for allowing me, I don't even know if they're going to let me do this again, but for allowing me to use their questions and to share those with you. So please don't forget to like and subscribe. If you would like to see other solutions, please feel free to ask for them in the comments. Have a great day, and I look forward to seeing you on the next video. Have a good one.